Good morning, everybody, and happy Monday. So, I'm going to give you my comments on the Italian referendum, the Austrian vote last night as well. And just to let you know that today I will be working on finishing up this week's edition of MMT Trader, which will be out later today. If you want to receive it, if you are not already on the list to receive it, and if you want a 30-day free trial, go to pitbulleconomics.com and click on the tab that says products, and you'll see a link there that says start my 30-day free trial. You'll get today's issue and you can download all of the back issues. Anyway, so we know the outcome of the Italian referendum. That was a landslide no vote. In Austria, the far-right candidate Hofer, he was defeated. So kind of a mixed bag of results. And the market, as usual, did what the least people expected, right? If you think back to Brexit. That was not expected to pass, and it did. If you think back to the presidential election, Trump was definitely not expected to win, and he did. In this situation, at least speaking of the Italian referendum, the no was expected to win. At least that's what the polls said, and the no's did win. What the expectation was, however, would be it was a very sharp sell-off in the euro, stocks down, maybe gold up, and the opposite happened. Okay, so once again, even though the vote outcome was what was expected, I think the market reaction was not what was expected. Let me just say a few things about the market, starting off with the euro. The euro, as I have been saying in my MMT Trader report, has a very, very high speculative short position embedded in it. Okay, so everybody sold, and that's why I was always skeptical that we would see, parity. I mean, there's just too many shorts in there. And it's not just the specs, it's asset managers too. A very high net short position. So everybody's in there. So the rally that we're seeing is, on the one hand, a short covering rally, but as I've also been saying over and over, the policies that we see in Europe, which let's call it austerity, which we know, and also monetary policy, which is deflationary, right? Negative interest rates, asset purchases, those things are fundamentally bullish for the currency over the long term. Now, we've seen a lot of portfolio selling based on these fears about the Italian referendum, and maybe the longer term fears about just the political volatility or uncertainty in general, or the outlook for Europe in general. And we see a lot of this built up in the positions, the short, net short positions on the part of speculators and asset managers. By the way, another currency which has a huge net short position is the British pound, which I advised buying last night when we were in the 126 handle. So the euro rallied, and I suspect that we could see a little bit more upside as some of these short positions get, stopped out or liquidated. Number one. As far as the stock market is concerned, I think when there wasn't a cataclysmic reaction to the referendum, we saw a relief rally in stocks. The fundamental backdrop right now remains the same as far as what I could see. We have zero growth in the fiscal flows. That's federal government spending here in the U.S. We also see a pretty marked deceleration in loans and leases and bank credit. Okay, that's something. I mean, if you look, it started at the end of September and literally fell off a cliff. There's some things I'm waiting on. For example, the House of Representatives passed the NDAA, that's the funding authorization for the defense bill. That was a $9 billion increase over what the president asked for. That'll go to the Senate this week, and then the president's probably going to sign that, even though he was initially opposed to any new increases. But he'll probably go along with that. We'll have to see how that factors into the flows. We know right now the flows are zero growth or even slightly negative year over year. What else? Gold, your typical selling here. People initially jumped in. There was no negative reaction. There's been selling in gold. Let me say this. There has been a massive, massive amount of long liquidation. Specs are still long, but their long position is now the lowest since February. And, maybe that has to go net short. That might have to happen before gold bottoms. So, we're just waiting to see. I think the rally in bond yields and the sell-off in treasuries is probably done for now. I said that last week. Just again, looking at the fiscal flows, looking at bank lending data, I just don't see, everything's about money. If the money's not flowing, if that water's not flowing out of the pump into the swimming pool at a sufficient rate, I mean, the pool is going to start to go down. The water is going to go down because there's leakages. There's always leakages in the pool. So I think right now the bond market has totally discounted this upcoming Fed rate hike on December 14th. I think it could even be a little bit of a buyer down here. I wouldn't get crazy, but I think it could be a little bit of a buyer. Crude up above 52, as I predicted a long, long time ago, and as I have been saying, all right? 52 to 55 was my range. And what else? I don't know. All right, I got to get back to work. I'll be back at you later. Let's watch what happens here. I wouldn't be surprised to see some of these early trends kind of peel back later today, but we'll keep an eye on it. All right, everybody. See you later. Bye-bye.